welcome to the channel createURWealth. Before we start our video today, I would request you to subscribe to the channel if you have not done. And if you feel that there is some story which we should know, please write it down in the comment section. Please click on the like button, click on the bell icon to stay connected.
Abhimanyu's Dilemma, the art of selling. To be a good investor, we need a robust framework for both buying and the selling of stocks. Most of the books have been primarily focused on the various facts of making great investments. Making an investment is half the battle, the easy part. We all need an equally robust framework for selling. Selling a stock is a more difficult decision than buying one. Thus, the need for a robust framework and some help from our dear friend Abhimanyu. I think all of you know the great hero Abhimanyu from the Mahabharata, the epic. We need to understand the reason for his situation in the battle where he was killed by most of the warriors. Though he was highly capable, he did not know how to come out, and that is the situation of the modern capitalist. We could learn a lot from his experience and become vastly a better investor. With 100,000 stanzas, Mahabharata, perhaps the greatest epic poem ever written. It had penned down in Sanskrit in India about 2000 years ago. When the main subject is a bloody fight between two branches of the North Indian ruling family, the Mahabharata is a story of a deep philosophical lessons. The family conflict culminates in an epic of an 18 days battle between the Pandavas and the Kauravas. The Pandavas are the good guys while the Kauravas aren't entirely an above board set. On the 13th day of the battle, the Kauravas had arranged their army in a deadly chakravyuh battle formation. A well-defined or designed chakravyuh is a archimedical spherical formation that is virtually impossible to penetrate. The Kauravas' chakravyuh was a havoc for the Pandavas' army. Arjun was sent little far. Their leadership was also very much worried about the staggering human loss they were facing. At this point, the story about a 16 years old flashbacks when Lord Krishna was explaining his pregnant sister Subhadra how a chakravyuh could be successfully penetrated all the way to its center. If one can break through and enter a chakravyuh, traverse it to its core and finally exit it is very effectively at neutralizing the enemy's leadership at its very center, leading to a mass panic and disarray among the rank and the file. This is easier said than done. Such a traversal is thought to be virtually impossible. Lord Krishna gave his sister a detailed narrative on how a chakravyuh could be penetrated and successfully traversed to its core. He was about to explain how he could safely exit the spiral when he noticed that his sister, bored with the tale, had fallen asleep. Krishna, finding himself without an audience, left the story unfinished. But there was an interested listener who was present there. From the mother's womb, the unborn Abhimanyu, who was keenly observing the discourse. Abhimanyu's father, Arjun, was the greatest archer of the world. Following in his father's footsteps, even at the tender age of 16, Abhimanyu was an accomplished warrior. Finding his sight sustaining deep loss, he offered to penetrate the chakravyuh. Even though he did not know how he could exit once he got to its center. Under the pressure, the Pandavas' leadership reluctantly agreed to let him proceed, planning to follow closely behind him to keep him out of trouble. Remembering the Lord Krishna's technique, Abhimanyu successfully entered the chakravyuh and swiftly advanced towards its center, slaying scores of Kauravas' troop who tried to stop him. However, the Kauravas were successfully in sealing off the chakravyuh right after the Abhimanyu's entry, so no additional Pandava could follow Abhimanyu's lead. At the center, 9 of the best Kaurava warriors were battled Abhimanyu simultaneously. Not knowing how to break out of the chakravyuh, Abhimanyu stayed put at the center and put up a brave fight with all the 9 of them. At the end, he was crumbled to his injuries and died. Abhimanyu's dilemma on the 13th day of battle was very close parallels to the decision confronting equity investors every day. The decision to enter, traverse, and finally exit the chakravyuh is akin to figuring out when to buy, hold, and sell a given stock. The lesson Abhimanyu has for us is to have a crystal clear exit plan before he ever thinks about buying a stock. To enter or not to enter? That is the question. Much of this book and many other books on stock market investing has fixating on various nuances of buying stocks. This by no means is a summary, but there are 7 questions that an investor ought to be thinking about before entering any stock market chakravyuh. Is it a business I understand very well, squaringly within my circle of competence? Question 2. Do I know the intrinsic value of the business today, and with a high degree of confidence how it likely can change over the next few years? Question 3. Is the business priced at the large discount to its intrinsic value today or 2 or 3 years from today? And is it over the 50%? Question 4. Would I be willing to invest a larger part of my net worth into this business? 5. Is the downside minimal? 6. Does the business have a moat? 7. Is it run by an able and honest manager? One should only consider buying if the answer to all the 7 is a resounding yes. If a well understood business is offered to you at half or less than its underlying value 2 or 3 years from now with a minimal downside risk, take it. If not, take a pass on entering this chakravyuh. There will be better chances in the future. Traversing the rings. It is amazing to me how many investors buy a stock for $10 and then feel uncomfortable when the price drops to $8, prompting them to sell the turkey and restart the quest for the next winner. They enter the chakravyuh lured by the reward at its center, but got their head handed to them without even getting past the first ring. To illustrate, let's imagine towards the end of 2006, a neighborhood gas station was put up for sale and the owner offered it for 5 lakhs rupees. It's just an illustration. Further, let's assume that the gas station can be sold for 10 lakhs rupees after 10 years. The free cash flow, the money that can be pulled out of the business, is expected to be 1 lakh rupees per year for the next several years. What is the intrinsic value of the gas station assuming 10% discount rate? I will show it on the screen. The intrinsic value of 10 lakhs is 10 lakhs. The gas station is being offered to us for 5 lakhs. What a deal. Now we know the intrinsic value is 10 lakhs and that we are going to buy it at 50% off, which is terrific. We made the investment. 2 years roll by, somehow someone is already offering us 9.5 lakhs for the business. What should we do? Should we run the business for the intrinsic value as we had calculated before 2 years, or should we sell it? Assuming that the cash flow remains steady, the intrinsic value is still 10 lakhs. Moreover, you have enjoyed getting the dividends of 2 lakhs in the last 2 years. With the offer of 9.5 lakhs, that is 95% of the intrinsic value, there is no barrier to sell. The final economics looks like this. You have invested 5 lakhs rupees. The total proceeds that you will receive is 11.5 lakhs, which is annualized return of 50%. Buying at a steep discount to an intrinsic value has enabled us to get 50% annualized return on the investment. Even though the gas station was only generating 10% return for us based on the cash invested. Let's take into account some of the Kelly's formula for the calculation of the gas station and the conservative odds on making the 2 to 3 years investment with the following calculations. The odds of 2 times or greater returns in the 3 years is 80%. The odds of break even in 2 times the return in 3 years is 15%. The odds of total loss to the break even to the return is 5%. We almost want to be conservative. Let's further simplify it. So 2 times return in 3 years, 80% chances. Break even in 3 years, 15% chances, and a total loss is 5% chances. This is a very favorable wager. Mr. Kelly suggested us that we should invest over 88% of our available bankroll on this investment. This was easy. Let us examine the more painful scenario. What do we do if the cash flow of the gas station dropped off dramatically after we bought because the prices went up to $150 a barrel? Now the gas station is producing just 20,000 per year as a free cash flow. About 6 months after our purchase, someone offers us to take the gas station off our hands for 1.5 lakh, that is 1,50,000. Should we sell it? The business is a living entity, and that's why it goes through the ups and downs just like human beings do. We don't know exactly how the future is likely to unfold. In this case, oil went off by $50 the barrel when we bought the gas station, and it went up to $150 a barrel, leading to a big decline in the volume and the revenue. It is the best to give the business off for some time to adopt it to this change. The oil might come back down, the consumers might eventually get used to the prices, or maybe the government can come up with some subsidies. The critical rule of the chakravyuh traversal is that any stock that you buy cannot be sold at a loss within 2 to 3 years of buying it, unless you can say with high degree of certainty that the current intrinsic value is less than the current price the market is offering. Let me repeat. The critical rule of the chakravyuh traverse is that any stock that you buy cannot be sold at a loss within 2 to 3 years of buying it, unless you can say with high degree of certainty that current intrinsic value is less than the current price that the market is offering. If we apply this rule to our gas station, the present intrinsic value is around 2 lakhs rupees or higher. It is no barrier to pass on it for 1.5 lakh offer. Because we are getting 20,000 free cash flow for 1 year, for the next 10 years we are expected to get it as 2 lakhs. Then why should we sell it for 1.5 lakhs? Secondly, you cannot nail intrinsic value to a high degree of certainty. Intrinsic value looks like it is at least 2 lakhs, but it could easily become 10 lakhs if the oil prices get corrected. Our future estimates of intrinsic value is likely a range between 2 lakhs to 10 lakhs. The gas station cannot be sold at a loss today for 3 main reasons. Reason number 1. It has been less than 2 to 3 years since we bought it. Reason number 2. We are unable to come up with a realistic intrinsic value with high degree of certainty. Reason number 3, present offered price is well below our conservative estimates of present intrinsic value. As a corollary, the only time a stock can be sold at a loss within 2 to 3 years of buying it is when both the following conditions are satisfied. Condition number 1, we are able to estimate its present and future intrinsic value 2 out of 3 years out with a high degree of certainty. The price offered is higher than the present or the future estimated intrinsic value. Our brain have undergone millions of years of evolution, yet they are poorly evolved to deal with the virgins of the stock market. When the lion roars, our brain tells us that start running. We don't process, we just run. When the stock market or the stock prices drops dramatically, the fear that sets in is similarly to hearing the lion roar. Our first intrinsic value is to sell the turkey, purge the memory of ever having owned it, and run away. This is one of the primary reasons why most investors do worse than the stock market index. They are enthusiastic about buying the stock. Then they have been rising. They are keen on the selling positions that have undergone a large drop. To counterbalance our messed up brain, we have to put rational chakravyuh traversal rules in place to promote rational behavior. The key to being a successful investor is to buy assets consistently below what they are worth. To fix it on absolutely minimizing the permanent realized losses, Warren Buffett's two main rules are: rule number 1, never lose money. Rule number 2, never forget the rule number 1. While valuation of public companies can go through dramatic changes in a matter of few minutes, real business changes takes months, if not years. The gas station has seen a dramatic drop in the cash flow. The future is murky. We need to allow enough time for the clouds to clear. The 2 to 3 years, it could be quite clear whether the price of the oil is likely to stay permanently at $150 a barrel or higher, and whether the government has stepped in to help, whether the consumers' conservative patterns were temporarily or permanently, whether the business model can be transformed to emphasize other products and services, and so on. Once 2 years have passed, the cash flow are still at $20,000 a year. We ought to open a sale board which says 2 lakhs or higher, then I am willing to sell my investments. Once 3 years have passed, all the shackles are off. At this point of time, I would be open to selling it at any reasonable price, even if it means a big loss on the investment. Markets are mostly efficient, and in most instances, an undervalued asset will come up and trade around its intrinsic value once the clouds have been lifted. Most clouds of uncertainty will dissipate into 2 or 3 years. The 3 years rule also helps us to exit a position whether they are simply wrong to our perception or intrinsic value. We didn't have always waited for a conservative intrinsic value. We have an endless wait. There is a very real cost of waiting. It is the opportunity cost of investing. There are assets elsewhere. Hence, there are balances between allowing a sufficient time frame for the stock to find an intrinsic value and waiting endlessly. Why 2 to 3 years? Why not 3 to 4 months or 6 months or 6 years? I don't have a rigorous proof of why this period should be 2 to 3 years. You know that a few months can be inadequate. Real business changes does take time. If the CEO were looking to make certain key hires and enter and exit certain markets, it takes months, if not years, and longer to accomplish the same. Similarly, our gas station is dealing with the shock of the business model. We need to allow some time for the clouds to lift, or at least thin out. Wait for 5 to 10 years for the clouds to lift and the business change will become visible if not too long. There is a very real cost of waiting. If we hold on the gas station for 10 years and eventually get back to 1 million including dividends, then reinvest the proceeds in another investment, then get out of the annualized returns at 12% for the next 10 years. Our current assets next 20 years is about 3.1 million. Alternatively, if we sell the gas station for 7 lakhs after 2 years, then the investment proceeds will be at the rate of 12% annualized return. We did nearly make 54 lakhs. In fact, if we sold the gas station for anything over 4 lakhs after 2 years, we do better than holding it for 10 years and selling it for 10 lakhs. It is very hard to come out of the lost non-compounding years. We must be patient but not wait endlessly. My conclusion is that 2 to 3 years is just about the right time of patience for losers to fix themselves. One of the best books on value investing I have read is Little Books That Beat the Markets. I will presume that the readers of this book already have read about the Greenblatt's book. His magic formula calls for all the stock market to be held for exactly 1 year. Whether the stock declines or appreciates, once you buy a magic formula stock, as per the algorithm, it cannot be sold for a year. Magic formula stocks are in general deep value stocks. They are mostly stocks where the lion has already roared and the stock has plummeted. The magic formula works because most of the roaring, if not all, ends over the course of the year. The rationality prevails, eventually leading to an average. The significant above average annualized return. 1 year is a very good holding time frame. But if you understand the business well before buying it, I believe the longer time frame is fully warranted and justified. The magic formula suggested that you buy stocks that you know nothing about. Hold it for 12 months. It takes logical sense that you did want to allow a longer holding period of business. If you have a very high degree of conviction on understanding the intrinsic value, feel free to hold on to a loser longer than 2 or 3 years. But always be cognizant of the fact that the time is value of money. It is very hard to make up for the lost compounding years, non-compounding years. The 2 to 3 years rule prevents us from running when the lion roars. It helps us to avoid distress sale at points of maximum pessimism. A wonderful example of loudly roaring lion is my roller coaster ride with Universal Stainless and Alloy Products over the past 4 years. Universal Stainless and Alloy Products, USAP, was founded in 1994. Since its inception, it was focused on manufacturing specialty steel products used in the niche applications like power generations, aerospace, and heavy equipment manufacturing. The company has 3 manufacturing facilities. All these plants were mothballed facilities and were acquired by the company for the next to nothing. The company spent a total of 10 million to acquire the 3 facilities. Over the years, it spent about 68 million in capital expenditure to enhance them. I was attracted to the business right after they acquired the 3rd facility in New York. All these 3 facilities had some common characteristics when they acquired it. They were flexible labor agreements. There were no legacy costs like pension or healthcare or the environmental liabilities. Acquisition price was 0 or pretty close to it. Duckrick was bought for 4 million, but it included inventories and excess assets worth 4 million. In addition, the US Universal Stainless only paid 1 million in cash, and the rest was in the form of 10-year note preparing 5% interest. The company effectively got the plant for free. Prior to the Dunkin's acquisition, the company had earned 1.26 per share in 2001. The tangible book value was $9 per share. The CEO of this company was a senior management from Armaco Steel when it developed the Dunkin facility. He had personally very familiar with Dunkin, and at one point he produced 100 million in revenue and could be scaled up to 150 million in revenue. At 100 to 150 in sales, earnings were likely to be north of $1.5, possibly to $2.5 per share. The Dhadho approach of buying Balmoth steel mills for pennies for the dollar reminded me of my hero Lakshmi Mittal. As you saw in his story, he ended up with becoming the wealthiest man on the world with some snoofy Dhadho approach for acquisitions. Get them for nothing and next to nothing. Mac and Mittal must have some commonality from their ancestral gene pool. At this point, we are deeply inside the chakravyuh, and the enemy appeared to be winning and closing in on us to kill. To survive, let alone emerge victorious, we have to learn to stay calm and follow the chakravyuh's ring traversing algorithm. The answer is based on the algorithm was self-evident. The entire steel industry was in doldrums. This wasn't a USAP specific problem, this was an industry-wide downturn. The intrinsic value has been very murky at this point of time, pretty much indetermined. Given the crystalline nature of the business, the odds were decent that things might get better when the demands come back. We had a significant unrealized loss. Less than 2 years had passed, and the intrinsic value was tough to figure out. There was a classic sign of being engaged in the furious battle in the heart of the chakravyuh. To have a shot coming out alive, the answer is obvious: do nothing. Just hold. As my mom always said, time is the best healer. Fast forwarding another year, it was now April 2004. The stock is trading at $10 to $11 per share. Dunkin is an average revenue rate of 27 million and profitable. The rest of the business is at 60 million run rate, but still not back to 2001 levels. The company-wide sale run rate is 85 million, and the company has a guidance that the next quarter sales are expected to be as high as 29 millions. There is a significant gap between the growing backlog. Many of the clouds which were over the USAP was dissipated. However, we are still looking for the unrealized loss. Further, USAP looked very good. I am very reticent to make a permanent loss on the capital. Buffett's rule number 1 and rule number 2 are worth keeping in front and center at all times. I decided to take a wait and see approach and let a few quarters to roll by. In 2005, USAP crossed $15 a share. Finally, all the tough battles spanning nearly 3 years were all on the positive territory. The good choices ahead was sell at small profit, 2 buy more, 3 do nothing. In 2005, USAP's revenue rate were about 150 million a year. The net income was 10.5 million a year. Backlog of about 72 million, the highest ever in the company's history. All their plants were running full. They were routinely putting through the price increase and surcharge to the customers for the minimal resistance. The run rate was 42 million. It is still a wide open runway to increase the sales 2 to 3 folds in the coming years. The original investment thesis was finally paying off. After nearly 3 years of intense chakravyuh battle, In 2005 May, the company decided to spend 2.5 million on the capital expenditure to install the sixth vacuum arc in the re-melt furnace. I have a vague idea of what such a furnace is, but I did understand from Mac on the conference call and that it would raise the EPS by 50 half dollar a cent per share. I have been in the furnace paid off very well, and this business spent that amount. Despite all these good news laid out in the conference call and press release, the stock languished between $10 to $17 per share throughout 2005. Needless to say that Pawari funds added up to the USAP position, maximizing it. Whenever the price weakened by the end of 2005, we owned just under 10% of the USAP. We were not very well positioned to exit the chakravyuh not only in one piece but with the enemy pretty much decimated. In 2006, the company announced that it was adding another vacuum arc furnace that would be fully operational in 2007. From my point of view, if Mac could keep those furnaces running for 24/7 for 365 days, he could buy as many of them as he wanted. The intrinsic value in 2007, even if for all the cyclical nature, was at least a save of $35 per share. Pawari funds decided to exit USAP at anything over 90% of the intrinsic value, that is $31. If there was another place I could deploy the proceeds, and at 100% of the intrinsic value if I am ready to sell regardless of what is the use of the proceeds. In 2006 April, the stock hit $31.5 for the first time. I began to unload our large positions. In May, the stock went over $35 per share, and we were unloading as aggressively as we could without even being 20% to 30% daily average volume or affecting the price. Our traders at Smith did a wonderful job by letting the shares out without tripping our hands. Around mid-May, an equity market around the world dropped significantly. The stock price dropped from 36 to 23 per share. Once the stock went under 31.5 per share, the Pawari fund stopped selling. As I write this, we have downloaded 60% of our holdings with an average of over 100% of gains. The remaining shares will be sold at least 90% of its intrinsic value. Some of these shares were held for around 4 years, yielding an annualized gain of 19%. The annualized gain of 100% in few years. All in all, it wasn't a home run situation, but a very acceptable result. I will continue to monitor the business on a quarterly basis and make necessary adjustment to the intrinsic value if there are significant developments. As I am penning down this paragraph on 19 June 2006, the stock is trading at $25 per share. The market is concerned about the weakening fundamentals over the company's steel company. The backlog has never been stronger. Their input cost of raw material has dropped significantly in the recent weeks. All in all, these reports record that the earnings in the coming quarters will be more than what we had expected. After 3 years, if the investment is still under the water, the cause is virtually always the misjudgment of the intrinsic value of the business. It could also be because the intrinsic value has been indeed declined over the years. Don't hesitate to take realized loss once if the 3 years have passed. Such losses are our best teachers for becoming the best investors. While it is always better to learn from our mistakes or the mistakes of others, the lessons that really stick with one are the stumbles through ourselves. Over time, learning from our own stumbles, we will begin to notice the diminishing number of unsuccessful chakravyuh attempts. Exiting the chakravyuh. Having successfully traversed the ring, the exit from the spiral is very simple. Within 3 years of buying, there is likely to be a convergence between the intrinsic value and the price, leading to a handsome annualized return. Anytime this gap narrows to at least 10%, feel free to sell the positions and exit. You must sell once the market price exceeds the intrinsic value. The only exception is tax consideration. If you are looking at short-term gains as a result, you should hold on at least till the long-term gains have been realized. The price is enough on a premium over intrinsic value to cover the extra tax bite. How many chakravyuhs should you simultaneously battle? Abhimanyu was consumed on his own attempt to traverse a single chakravyuh. How many simultaneous battles should we engage in at one time? Warren Buffett, without fixating on Kelly's formula, had often been highlighting the benefits of concentrating on the equity ownership. A lot of great fortune in the world has been made owning a single wonderful business. If you understand the business, you do not need to own many of them. Really understanding and outstanding investment opportunities are rare enough, and that you should really have to go at it and when it comes around and put a huge portion of your wealth into it. I have said it in the past, and you should think of investment as though you are punch cards of 20 holes in it. You have to think really hard each one. And in fact, 20 in a lifetime is a way more than one can need to be extremely well as an investor. As per Charlie Munger, this idea of a zero currency in academic circles. Investment managers don't feel that they will make enough money this way. It's so foreign to them. True to form. Most mutual fund managers think nothing of starting several new battles daily. With well over 100 simultaneous chakravyuh travels, there is no surprise that 90% of them will consistently lag the index. Bill Rose used to say that if you have harmed 100 girls, you never get to know any of them very well. The trick is to know a lot about what you own, and you don't own so many things. The mantra is simple: few bets, big bets, infrequent bets, all placed well in the odds of overwhelming in your favor. The Kelly's formula is an excellent guide to figuring out how many stock you should own. A quarter Kelly is good to go. If you can hold your holdings for 5 to 10 diverse, well understood value stock in your portfolio, you are well on your way of transing to the market and disseminating one of the chakravyuhs one after the other. Abhimanyu faced a difficult dilemma. As a vigilant warrior, he had left with no other choice but to enter the one formidable chakravyuh in front of him. He could not have time to his entry and to his advantage. With no exit plans, his unfortunate fate was sealed. We have the luxury of choosing just a handful of chakravyuhs from over 30,000 opportunities that are available in the investing lifespan. Choosing these carefully selected chakravyuhs at a time when the soldiers are asleep all guarantees successful travels and big rewards. We will continue with the father's story, that is Arjun's story, in our next video. Thank you.